Welcome to our corporate accounting class. In today's class, we are going to discuss about accounts of holding companies. This is a problem taken from Advanced Accountancy, Jain and Naran. See, in this problem, we are having some important and technical aspects. That those technical aspects are essentially required for getting the knowledge in full-fledged knowledge in accounts of holding companies. Number one, how to treat the uh, mutual owings. You know what is mutual owings? Basically, the basic meaning, the literal meaning you can understand. Mutual. See, both the companies are mutually having some debt. Then that should be adjusted. For example, to say, holding company has to pay some amount to subsidiary and subsidiary company should pay some amount to or is in a position to pay some amount to the holding companies. Both the companies holding and the subsidiary are belonging to the same group. Okay, so giving, receiving, and again amount given by the subsidiary to holding. Both the things are supposed to be affected in the balance sheet, in the same balance sheet, that group balance sheet. So instead of passing two entries, better we can adjust both the amount. Final effect is given in the consolidated balance sheet. This is called a mutual owing. This is given normally in or against the bills receivable and bills payable, and debtor and creditor we will have the mutual owing and mutual indebtedness. Okay, this is one important point. And another one important point is treatment of profit on unrealized stock. What is that unrealized stock? Normally, the stock is supposed to be accounted on cost value, whereas if it is sold to outsider, it should be accounted on sale value or invoice price or sale price. Whereas sometimes by mistake that stock sent to the group company holding to subsidiary or subsidiary to holding, this is the group transaction only, it should be recorded in cost value, but by mistake the same is accounted with profit. Okay, this profit is not earned because of the sales. This profit is earned because of unrealized stock. That is, the profit is earned without sales. Okay, that should be adjusted. How to treat that? In this, we have to take the help of accounting standard 21. What is that? It says that any amount of unrealized stock is made, the percentage of a profit should be adjusted and full provisioning should be made. See, in this question, we are given with 25% profit on cost. See, in plus 1 plus 2 and in first year accounts, you might study that final accounts, you might study the concept of application of rates. What is this profit on cost? Any profit on cost can also be interpreted in terms of profit on sales. Simple. What is the formula for this? Percentage of profit divided by 100 plus that percentage of profit. See, in this 25%, in question it is given as 25% profit on cost. So 25%, 25 divided by 100 plus 25, that gives you the profit on sales. That is, it can also be interpreted in terms of profit on sales. Instead of taking that 25%, we can take 25% is 1/4, right? So 1/4 is profit on cost. The same is converted in terms of profit on sale. That is 1 divided by 4 plus 1, 1/5. 1/5 in terms of percentages is 20%. So profit 25%, profit on cost is also considered, it is same with 1/5 on profit and cost, 1/5 on sales or 20% on sale. See, in this question, it is given that 25% profit and cost. So 25 divided by 125 is taken as 1/5. Okay, and the total transaction is 10,000. It is given as adjustment. 50% of the stock is unrealized stock. So 5,000. Okay, that 5,000 into 20%, that is 1/5. 1/5 on 5,000 is that comes to 1,000 rupees. This 1,000 rupee is taken as unrealized stock, that is without sales you accounted the profit, should be deducted. Okay, this is taken as the profit without sales. So this should be deducted from where? From one effort it should be deducted from the profit in the balance sheet. And another one is this is included as a profit along with the stock. So one effort should be deducted from the stock. 1,000 rupees should be deducted from the stock. The same 1,000 rupees, second effect, same 1,000 rupees should be deducted from the P&L account. Okay, so you know very well, holding company profit and loss, that is the surplus. Then revenue profit, share of that revenue profit you are taking. Along with that, you should deduct this 1,000 rupees from that profit. Okay, so these two things are the most important aspect in accounts of holding companies. Rest of the things are same. See, as far as this problem is concerned, what we are having, total share capital of S Limited is 2 lakhs. Of that 2 lakh, 80% contributed by the holding company. So 1 lakh is 60,000. Balance of 40,000 is contributed by others, right? Then calculation of profit. The general reserve given in the question is 80,000. Surplus at the time of acquiring the subsidiary is 30,000, right? We are given with the adjustment that surplus up to that 1st October acquisition of the subsidiary company is 30,000. So 6 months we have to adjust. Why 6 months? See, April, May, June, July, August, September, right? September 30th, because 1st October the new company has acquired. So 1st October, so 30th September we have to take. So for that 30,000 into 6 by 12, 15,000. So total of capital profit is first 80,000 general reserve, because it is specifically given. General reserve is remain unchanged, no changes witnessed in general reserve. At that time of acquiring the company, surplus was there, it was 30,000. So 80 plus 30 we have to take. Then balance 15,000 is adjusted, is taken. Total 30,000, surplus account is 60,000. At the time of beginning 30,000 was there, then balance 30,000, 6 months we have to eliminate. So 1,25,000 is the capital profit. It should be apportioned between holding company and minority on the ratio of 8:2. Then revenue profit. Total surplus is 60. On that, initial 30,000 plus this 30,000, 6 months profit. So 15,000. Total 45,000 is deducted from the 60,000. So balance of profit available for the revenue period, that is for the post acquisition period, is 15,000. That amount comes to 15,000 should be apportioned between 8:2. Then minority interest, you know very well. What is that minority interest? The value of profit, capital and revenue profit for the minority. Okay, so total face value of the shares. Total shares 2 lakh. Of that, holding company contributed 1 lakh 60. So balance of 40,000 is by the minority. So 40,000 plus share of capital profit, share of revenue profit, 25 plus 3. So total minority interest is 68,000. Okay, then calculation of goodwill. How to take the goodwill? Amount of investment minus face value of the shares contributed by the holding. Here that comes to 1,60,000. So face value is 1,60,000. Then share of capital profit already we calculated and apportioned between the holding and the minority. That comes to 1 lakh rupees. In the first part we have the workings, that is working note number 1. So 1 lakh 60,000 plus 1 lakh plus 3 lakh 40,000, total comes to 80,000 is the goodwill. Just now only I explained the treatment of profit, and minded in this that the treatment of a profit on unrealized stock should be taken only as per AS 21. Okay. Then mutual owing also I explained just now. Then finally you will have to prepare the balance sheet. So for practice, you try to prepare the balance sheet.